Hello and welcome to Stockwatch, presented by me, Evan Lucas, for Go Market Securities. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of which relied upon as any form of personal advice. Go Market Securities does not know your personal scenario, nor your personal financial goals, and therefore none of which relied upon as any form of advice at all. It is just general in nature only. I'm going to go a little bit off script, and I do need to concentrate on what's going on with Silicon Bank and also what's going on with Signature. Silicon Valley Bank and Signature Bank will go down in history at the moment anyway as the second and third largest collapses of banks in US history behind Lehman's. Now, there needs to be a caveat to that to put into perspective that if you were to compare Lehman's today to when it was went down in 2008, it'd actually be about 4 times larger than what it was. So it does need to be put into consideration. These are small banks, there's no doubt about that, but the contagion risk and where it comes from also needs to be looked at. Because what does it mean for those of you that are invested in banks? What does it mean for your investments globally? And that is what I think needs to be pointed out. It is clear that there is some form of liquidity squeeze. We knew that. But if you look at what SVB and also what Signature were doing, their risk management was really poor. In fact, it was more than poor, it was non-existent. And that is not what you would expect at the larger end and the regulations that came around at the end of the GFC. You then look domestically here in Australia. If you look at something like CBA, they're very proud and they talk about it loudly that the majority of their funding comes from the retail investor, the term deposit holder. It's about 70%. And that money is not only very sticky, it's very secure, and it also has the backing still of Kevin Rudd's 2007 government guarantee. What does it therefore also mean though for the run-on in the market? The market will ask many questions about this. Does it therefore mean that the Fed will have to go away? Possibly. So far, you've seen them going from pricing in rates at the end of the year at 5 to 5.25% down to as low at the moment of 3.5%. That means they expect cuts, not just one, but several by the end of the year. Not sure about that. That feels like an overreaction, but certainly something to be aware of. What does it mean for the RBA? Again, they were looking for reasons to pause. And if there is suggestions that there is systematic risks inside the markets and that liquidity could be seizing up, gives them that opportunity to maybe pause and say that yes, we're still watching inflation. Yes, inflation is something we need to beat, but we are also aware that it is starting to cause ructions and what we've done in the past may be enough. So watch that space. There is no doubt though that there will be a pullback. There is no doubt that those that are exposed to the financial services sector is going to feel quite a bit of heat in the next couple of weeks to a couple of months as we filter this out. And that therefore means that whatever happens, your strategy has to be 110%, and make sure that you are very much on board with what you're trying to do, because events like this, system risk, as we refer to it, they are part and parcel with investing, and we're going through another one now.